In the early hours of August 24, 1992, a Category 5 hurricane crossed the coast of southern Florida, and in 4 hours, it flattened entire towns into matchwood. But this story is not really about the wind. It is about what the wind broke, the one industry whose entire job is to survive disasters. Hurricane Andrew produced a bill so far beyond anything the insurance business had ever imagined that 11 insurance companies collapsed outright, and the survivors discovered, to their horror, that they had been pricing catastrophe, by guessing. This is the strangest collapse in this series. No rogue trader. No hidden account. No corrupt government. Just an industry that sold millions of promises against a monster it had never actually measured, and the morning those promises all came due at once. It is also the story of one woman with a computer model everyone laughed at, an island that became the world's insurance vault, and the reason your home insurance looks the way it does today. Start with the target. For 40 years after the war, Americans poured into Florida, the Sunshine State, the retirement dream. The coastline south of Miami exploded with subdivisions, condos and trailer parks. The population of South Florida had multiplied many times over. Trillions of dollars of property now stood where hurricanes had always come ashore. And nearly every roof, every wall, every life inside was covered by an insurance policy that promised, if the storm comes, we will make you whole. Here was the quiet catch: hurricanes had, by pure luck, mostly stayed away. Between the 1960s and 1992, no truly catastrophic storm had struck a major American city head-on. A whole generation of underwriters had priced hurricane insurance during the calmest stretch of weather Florida had ever recorded. The risk hadn't gone anywhere. It was just waiting. And the people selling protection against it had begun to mistake a lucky streak for the law of nature. And behind the insurers stood a second, hidden industry most people have never thought about: reinsurance, insurance for insurance companies. A Florida insurer would pass slices of its hurricane risk up the chain, to giant reinsurers in London, Munich and Zurich, who sliced and passed it on again. In theory, this spread catastrophe across the whole planet's capital. In practice, nobody could say exactly where the risk had ended up, a question that was about to be answered the hard way. Because here is the astonishing truth about how the industry priced hurricanes in 1992, it looked backwards. Underwriters took a few decades of loss history, the calm decades, and extended the line forward. There were no simulations. In many firms, the worst case for a single storm was imagined at $7 or $8 billion, and even that was considered alarmist. The most sophisticated financial industry on earth was pricing the apocalypse with a rear-view mirror. There had even been a warning shot. In 1989, Hurricane Hugo tore through South Carolina and produced about $4 billion in insured losses, at the time, the biggest hurricane bill in American history. It should have been a fire alarm. Instead, the industry filed it as a freak, an outlier, a bad year, not a preview. Premiums barely moved. The rearview mirror had spoken, and the rearview mirror said everything was fine. A few people saw the flaw. One of them was a young analyst named Karen Clark, who did something in the late 1980s that the industry found almost eccentric. She built a computer model that simulated thousands of hypothetical hurricanes striking today's coastline, today's buildings, today's prices. Her machine kept producing numbers the market refused to believe, that a single storm, in the wrong place, could cost tens of billions. Executives smiled politely. Some laughed out loud. Nobody changed their prices. In the last days of August 1992, as a compact, furious storm bore down on Florida, Clark's firm ran the track through its model and printed an estimate no one in the industry had ever seen in writing: roughly $13 billion in insured losses, nearly double the imagined worst case. The number went out while the wind was still blowing. Old hands called it absurd. In a few weeks, it would prove to be conservative. The storm itself almost didn't happen. Andrew spent days as a ragged, dying depression in the Atlantic. Forecasters nearly wrote it off. Then it crossed warm water and detonated. In 36 hours it spun up into a Category 5 buzzsaw, small, fast and vicious, aimed at the suburbs south of Miami. This is Andrew from orbit on August 23, that black dot of an eye, tightening like a drill, one day from the coast of Florida. It came ashore near the town of Homestead at 5 a.m. on August 24, with sustained winds around 165 miles per hour and gusts far beyond what the instruments survived to record. The anemometer at the National Hurricane Center broke. Radar antennas were ripped from rooftops. For 4 hours, the southern suburbs of Miami were inside something close to a 40-mile-wide tornado. When the sun rose, South Florida did not look damaged. It looked erased. Whole subdivisions had been planed flat, street after street where every single house was gone, and only the concrete slabs remained, laid out like gravestones in the grid. 250,000 people were suddenly homeless. Homestead Air Force Base was wrecked. This FEMA aerial is what the adjusters found, not claims. Obliteration. What followed on the ground was an American humanitarian crisis. 250,000 people slept in cars, tents, and the shells of their homes through the Florida summer. The National Guard patrolled against looters. Families painted pleas for help on their broken roofs in letters big enough for the news helicopters. Federal relief was slow and chaotic. The fury it caused reshaped American disaster response. Into this misery, the insurance system was supposed to deliver its promise. Much of it did. Some of it simply wasn't there anymore. Then came the second storm, the paper one. More than 700,000 insurance claims poured in, a flood no company had ever processed. Adjusters wandering the rubble couldn't even find the houses they were supposed to assess, because the streets had no signs and the houses had no walls. And as the estimates climbed, 8 billion, 10, 12, finally about $15.5 billion in insured losses, the industry realized the unthinkable. Andrew had roughly doubled the worst number anyone had dared to imagine. For the giants, it was a body blow. For the small Florida insurers, companies that had happily concentrated their entire book of business along the sunny coast, it was an execution. 11 insurance companies were declared insolvent, unable to pay what they owed. Hundreds of thousands of families, standing in the ruins of their homes, discovered that the company holding their promise had died with the storm. The shockwave even reached the most famous name in the business, Lloyd's of London, the 300-year-old market where the world's strangest risks are traded. Andrew's losses landed on Lloyd's in the middle of its own self-inflicted crisis, risk that had been passed around and around the market in a spiral until no one knew who truly held it. Thousands of private investors, the famous names, were financially ruined. Lloyd survived, barely, and rebuilt itself so the spiral could never happen again. Florida's safety net, a guarantee fund financed by levies on the surviving insurers, dragged the orphan claims out of the wreckage, slowly, painfully, at a discount. But the deeper shock was in the boardrooms of the survivors. Allstate alone had paid out around $1.9 billion more than it had collected in Florida in years. Executives stared at one simple, terrifying sentence: if this storm had turned 20 miles north, into downtown Miami, the loss would have been 3 times bigger, and almost no one would have been left standing. So the survivors did the rational, brutal thing: they ran. Within months, insurers moved to cancel or refuse renewal on hundreds of thousands of Florida policies, to shrink their exposure before the next storm. The state, facing a mass exodus that would have made homes unsellable and mortgages impossible, slammed the door with an emergency moratorium: you may not abandon Florida. The industry that existed to absorb catastrophe was now in open conflict with the state over who would be forced to hold the risk. To catch the abandoned homeowners, Florida built insurers of its own, state-backed pools that swelled within a few years to nearly 1 million policies, and a state catastrophe fund to backstop the next monster. It solved the emergency, and created a question that has never gone away: when private companies decide a risk is too dangerous to touch, the risk does not vanish. It just moves onto the public's books. Remember that. It is the ending of this story, and it is also the beginning of the next one. For homeowners, the new mathematics arrived on the renewal notice. Hurricane deductibles were rewritten from flat dollars into percentages of the home's value, thousands of dollars out of pocket before a claim pays a cent. Coverage narrowed, premiums along the coast began a climb that has never stopped. It was fairer, actuarially. It also ended an illusion Americans had enjoyed for a generation, that living in paradise, on the path of the storms, could somehow cost the same as living anywhere else. And then, out of the rubble, came the revolution. The catastrophe models everyone had laughed at became, almost overnight, the industry's Bible. Karen Clark's firm and its rivals were besieged by the same executives who had dismissed them. Within a few years, no serious insurer priced a hurricane by memory again. Risk was now measured in simulated storms, tens of thousands of synthetic hurricanes run against every building in the portfolio. Andrew had dragged the industry, kicking and screaming, from folklore into mathematics. The money followed the math. Within about 18 months, roughly $4 billion of fresh capital raised 8 brand new reinsurance companies, insurers for insurers, not in London or New York, but on the island of Bermuda, where they could be built fast around the new models. Andrew effectively founded modern Bermuda as the catastrophe capital of the world. And when even that wasn't enough, the industry invented something stranger: catastrophe bonds, packaging hurricane risk itself and selling it to Wall Street investors willing to bet on the wind. The storm rewrote the buildings, too. Investigations found that much of the destruction wasn't fate, it was shoddy construction, staple-gunned roofs, unbraced gables, decades of complacent inspection. South Florida answered with the toughest building codes in the United States: impact windows, roof straps, standards that treat a house as a machine for surviving wind. You can measure the result in later hurricanes. The homes built after the new codes stand, too many built before them still don't. The reforms were tested in 2005, when Hurricane Katrina drowned New Orleans and produced an insured loss nearly 3 times Andrew's. The industry shuddered, and held. The models, the Bermuda capital, the cat bonds, the machine built out of Andrew's wreckage absorbed the biggest insurance loss in history without a systemic collapse. In the perverse accounting of finance, the 11 small insurers that died in 1992 may have saved the whole industry 13 years later. But the ending of this story is still being written, because the retreat has begun again. In the era of warming seas, insurers are once more fleeing Florida and California. Premiums have doubled and tripled. State-backed insurers of last resort are again the largest in their markets. The question Andrew asked in 1992 has returned, bigger: what happens when the mathematics finally says that some of the places we love most cannot be insured at all? And the cycle is visibly turning again. In the early 2020s, a string of smaller Florida insurers collapsed years apart from any single giant storm, bled out by litigation, roof fraud schemes and reinsurance costs, and when Hurricane Ian ripped across the state in 2022, its bill rivaled Katrina's. Once again policies are being dropped by the 100,000, once again the state-backed insurer is the biggest in Florida. Andrew's ghost is not history. It is a forecast. The lesson of Hurricane Andrew is the purest in this whole series. Insurance is a promise priced on the past, and the past is not the future. Barings trusted yesterday's controls. LTCM trusted yesterday's correlations. Japan trusted yesterday's land prices. And an entire industry trusted yesterday's weather. Every collapse in these files is, in the end, the same collapse, the day the world stopped behaving like its own history. There is one more thing Andrew changed, and it is the least technical and the most important. Before 1992, insurance was sold as a certainty, a promise that if the worst happened, someone would make you whole. After Andrew, everyone in the industry understood the truth. An insurance policy is only as strong as the balance sheet behind it, and balance sheets can die. Hundreds of thousands of Floridians learned that lesson standing on a concrete slab where their house used to be, holding a policy from a company that no longer existed. And that is why this small storm belongs in a series about banks and traders and defaults. Insurance is the financial system's shock absorber, the thing that lets everyone else take risks at all. Mortgages exist because homes are insured. Ports, factories, aircraft, hospitals, all of it rests on someone, somewhere, promising to pay when the worst happens. Andrew was the moment the world discovered that the shock absorber has a breaking point, and that nobody had ever bothered to measure where it was. So here is the question I'll leave you with. The storm that broke the insurance industry cost $27 billion in 1992. Today, a direct Category 5 hit on downtown Miami is estimated at several hundred billion. The models exist now. The warnings are in writing, just like Karen Clark's was. So, are we the industry that learned from Andrew, or the one that laughed at the printout? Tell me in the comments. And subscribe, because on this channel, the ledger always comes due.